I'm Matthew Williams, founder of Williams & Associates Wealth Stewardship at Richardson Wealth, where I work with clients and high net worth families who want to think clearly about their financial lives, not just react to headlines. If you're a Canadian investor, business owner, or entrepreneur, you've been swimming in commentary about Trump, about tariffs, and trade for months now. Most of it's either alarming or dismissive. Very little of it actually helps you think. Late last year, the Trump administration released a document called the National Security Strategy. I read it a couple of times, and a few lines genuinely stopped me. And I thought, if this is how the world's largest economy is framing its role going forward, that's worth understanding. So I reached out to Peter Perkins. Peter is a founding partner at MRB Partners, also known as the Macro Research Board, an independent research firm that provides top-down global investment strategy to some of the most sophisticated institutional investors in the world. Peter spent years before that as a managing editor at BCA Research, one of the most respected names in global macro research. Over a 25-year career, he's covered every major asset class and region, lived and worked in the UK, Hong Kong, and Canada, and now is based in the US. He sits at the intersection of global economics, policy, and capital markets. He speaks regularly at investment conferences and participates directly in investment committee meetings for select asset managers, meaning the people who run serious money trust him to help them think. And that's really what this conversation is about. Not politics, not predictions, a framework for thinking clearly about the environment we're all operating in, and why, as Peter puts it, we may be reading the first chapter of a very different book. I hope you enjoy. My guest today is Peter Perkins, founding partner at MRB Partners. Peter has spent his career translating macroeconomics and global policy into something actually useful for investors. And given everything that's happening right now, I couldn't think of a better person to have this conversation with. Peter, welcome. Before we dive in, I'd love for you to introduce yourself and tell our audience a little bit about your background and the work you're doing at MRB Partners.
All right, thank you very much. So yes, my name is Peter Perkins. I'm a founding partner of MRB Partners, which is the Macro Research Board. We do top-down global investment strategy. I write a regular piece on global asset allocation and cover a lot of things. I've spent my career doing emerging markets. I lived in Hong Kong for a number of years. I lived in the UK. I lived in Canada for 14 years. So I've gotten around and covered most asset classes and regions around the world and have been doing multi-asset strategy for about 25 years. I will say this, I grew up in Washington, D.C. and have been a political junkie since my early days. So I've always loved politics and still pay very close attention to U.S. politics and the implications for capital markets. So I'm happy to be here.
Perfect. So that's great. So here's why I wanted to have this conversation. You know, Canadian investors right now are swimming in commentary about Trump, tariffs, CUSMA renegotiation, and most of it is either alarmist or dismissive. What I find is there's very little in the way of helping people think about it clearly as it relates to their wealth, their businesses, and their financial lives. The Trump administration released a document late last year called the National Security Strategy. I've read it over a couple of times. I encourage people to do so. Maybe it makes some of the news make a bit more sense. But a few lines certainly stopped me. And I thought, if this is how the world's largest economy is framing its role going forward, that's worth understanding. So that's what we're going to do. Not necessarily politics, but a bit, and not necessarily predictions, but a bit, but mostly a framework for thinking clearly about the environment we're in. So Peter, let's start here. Our clients are hearing a lot of alarming and confusing commentary about tariffs, CUSMA renegotiation, and Trump's broader trade agenda. As someone who studies this professionally, where do you even begin to separate what's structurally meaningful from what's, negotiating theater or theater in general?
Well, the first thing I would say is, we have to be clear about Mr. Trump. Everybody characterizes him as a transactional person, and he is. I think policy is formulated as much at 2 o'clock in the morning because something happened to him as it is, really strategic perspective after, a lot of input from senior policy and experienced people. So we just have to accept that. I mean, and he likes noise. He likes conflict. He likes tension. And so that's just part of our world, and we'll have to live with it for however long he and his supporters are around. But the first thing I would say is it's always important to understand what the backdrop is, the fundamental backdrop is. So when you're looking today, if I really make this very simple, and even apart from the national strategy or security strategy document, is to say, look, we've had about a 40-year period where lots of things have gone good for investors, right? The global economy's been pretty healthy for a long period of time. Asset prices have risen a lot because we had a long period of disinflation and lower interest rates. And so, that always needs to be kept in perspective, because the starting point for asset prices in general is high, right? So whatever you think about noise versus fundamentals, you have to keep that in mind, right? And I think many investors make the mistake of looking at history and saying, well, this is what the stock market typically does. And the thinking, particularly when people look at the US market, is you're going to get bailed out even if you make a mistake today. History doesn't, because something happened, isn't that important. It's why it happened and whether the things that caused it to happen are going to happen in the future. And the answer is it's going to be more difficult to earn the kind of returns in the future that people have been accustomed to in the past several decades, notwithstanding whether it's the Trump administration, somebody else, whatever the national strategy, security strategy is for the United States. But I think the corollary to that is noise is noise. That's the whole point of it, right? And what you're trying to get at is the fundamentals, right? And the fundamentals, capital markets don't generally get too rattled by noise, right? Particularly geopolitical noise. They understand that, there are threats and so forth, and we can get nervous for a while. But really, noise depends on whether it's going to alter the underlying economic outlook. Because at the end of the day, the economic outlook drives stocks, drives bonds, drives currencies. So is all that noise going to translate anything? And, at least it seems to me when we look over the past couple of years, Trump, the tariffs that started in April, yes, people thought they were going to be very, very severe, and we had a severe impact briefly, but subsequently other factors drove the market, and those other factors, really, if you think about stocks, earnings were very good, right? At the end of the day, that's what the principal driver of stocks is, right? When you go back and you look at the Ukraine war and you think the implications for Europe, they're terrible, but the reality is other factors drove European stocks. European stocks are at highs now. Even we look at Canada, for all the difficulties in the negotiations and discussions with the United States, whether it's about the free trade agreement or agreements more generally, or the U.S. threat of trying to get Canada to become a 51st state or whatever, the Canadian stock market has actually done quite well as well. So, the fundamentals matter. And what I would say when I look at this is, if you look at the global economy today, the global economy is pretty resilient. It has proven its resilience over the past couple of years. It's a pretty, we're already a pretty mature economic expansion phase, really, right, including in Canada. But it's a resilient economy. And unless we get hit by something else, that's likely to be the driver over the next 6 to 12 months. So noise is something that we're going to get, but looking through it, personally, I don't think, for example, I hate to say this, but watching, financial market news is the kind of thing that causes people to do dumb things rather than causes them to step back and reflect both about their own financial goals and what they really feel about, risks or other things. So, but the global economy is in pretty good shape. Look, we're confronting the prospect of a war with Iran, right? So let's, I don't know whether that's going to happen or what the implications are, but one thing we do know is really oil prices have been pretty low. And, that's better for the U.S. maybe as a consumer than it is for Canada as an exporter. But there's a surplus of oil in the world. So there's a cushion even against that kind of risk. This is not 1973, 74 with an oil embargo or 1979 with another one. We're in decent shape to handle it, right? So keep your eyes on the economy and recognize monetary policies supportive, fiscal policies are supportive. We're in an economic expansion phase. Things look decent. Don't get too stressed about the noise.
Yeah, absolutely. That's great points. And what you'd opened up there with the starting point being pretty high. I just a couple of days ago submitted my annual investor letter to our marketing group for distribution, and I speak about that just in terms of how it's difficult to generate, more difficult to generate returns looking forward, and kind of how we're looking to do that. So it's great to hear you really double down on that as well. Sort of my next question, I guess, and you touched on a few things there, which was global economic resilience and so on and so forth. And in that national strategy document, there's a header that stopped me when I read it. And the administration writes that economics are the ultimate stakes, not military deterrence, not geopolitical competition, economics. Peter, when the world's largest economy puts that at the center of its entire strategic framework, what does that mean for how the rest of us should be thinking about the environment that we're in?
Well, I guess I would start off by saying, and I'm an American, right? And I now live in Dallas, Texas.
Right.
And, to quote James Carville, the former political advisor to Bill Clinton, and with nothing malintended, but as he said, it's the economy, stupid, right? And it always has been. The U.S. military power, U.S. political power, U.S. soft power has really been built around the U.S.'s economic power, right? Which has been diminishing to an extent, since the aftermath of the Second World War, but was really unprecedented or unparalleled, for a long period of time. So I don't see the national security strategy document as really. It says something different than the U.S. would have said before, because the U.S. has always presented itself as focused on ideals and ideas rather than raw economic power. But the military power derives from U.S. economic power, right? U.S. military strategy derives from U.S. economic power, because the U.S. willingness to protect open seas around the world, even in South China Sea and things like that, it has been, or the Malacca Straits in Southeast Asia, has been predicated on the notion that the U.S. has historically been the biggest beneficiary of the open trading system and globalization. Mr. Trump and many of his advisors don't agree with that, but I think the corporate sector in the United States would say, and the strength of the stock market, the strength of corporate profits in the United States, are an unequivocal reflection of the fact that the U.S. has been a major beneficiary of it. What the national security strategy document really, I think, highlights is the use of economic power is going to change, right? Mr. Trump wants to use his economic power, arguably, to subject other economic agents to do what the United States wants them to do, and that is a difference verbally. Even though one might argue that the U.S. has always done it, however, with the sheen of diplomacy, over it.
Yes, yes. So it's in you can. It's a really fascinating, because you can look at sort of American diplomacy or interaction with different countries around the world over the last 100 years, I suppose, or in the so even more, and yeah, you're right. There's typically a sheen, but this is, I guess, more naked from that perspective.
Yes, more naked. Yeah.
Right.
But yeah, and I would say realistically, any international leader would have been naive not to recognize that the U.S. was always using its economic power and exerting pressure on other nations. However, it was done in a more diplomatic way. But the other thing that's important and is a big difference, and this is, I think, a larger thing that people, some people recognize and some don't. We built the post-World War II global economy initially around the notion that the US was the only economy that wasn't bankrupt after the Second World War. And there was only one economic recovery or development strategy, and that was make stuff and sell it to the US, right? And so we built the system on that basis, right? And now the US, that national security strategy document reinforces that the U.S. is no longer willing to support that system. Now, I will be honest, I wrote a piece almost 10 years ago saying the global trade and reserve payment system has passed its sell-by date. This has been obvious for a long period of time, but neither the U.S. nor Canada, nor Asia, nor Europe knows what to do next, right? We've had this for so long, everybody sort of preferred if we could just sort of stay where we're at, even though we know the system is, has passed its sell-by date, but we don't know what to change to, right? And the threat from the national security strategy document is the US is saying we're changing. And you as Canada or you as Singapore have to just live with it. But of course, the world's interconnected and interdependent, and so the U.S. is finding it has to deal with the ramifications and fallout from that as well, right?
Right. And I guess that moves us nicely into the kind of the next point. And while we're setting up this discussion over email, you made an interesting point that, sustained shifts in capital flows, which would, I guess, be a result of kind of what you're talking about there, would have much larger implications than most people realize. For someone trying to understand the bigger picture, not just markets, but the economic environment itself, can you walk us through that framework around capital flows and stuff like that?
Well, the first thing I always like to say about capital flows is capital flows, it's kind of dual entry bookkeeping, right? Capital flows are the other side of trade flows or current account flows, right? So, I mean, one interesting thing about the United States that some people, it appears to me, in the administration don't quite recognize is that capital flows are what finance the US current account deficit, right? So just if we want to make it very simple, you can't close the current account deficit and increase capital flows into the economy. They're two sides of the same coin, right? So, when you're asking for more investment from the rest of the world and you want to close your current account deficit, you'd have to see, if you want more direct investment, you'd have to see less portfolio investment, because the two things have to be equal to one another, right? With a negative sign, different sign. So the thing that's important about it is understanding that this is just accounting, and the adjustment process can come from the capital account side. So flows of investment can cause changes in trade, or changes in trade can cause changes in flows of investment. You can pick, well, not necessarily, but you might be able to pick which one you want to emphasize. And Trump has verbally emphasized, let's reduce the current account deficit. But as a matter of fact, if you do that, you must reduce capital inflows, right? But so that's just the math of accounting, right? But the other thing that's very important, and maybe Canadians are less aware of this in some ways than other people are, but the U.S. has been, as I said, the beneficiary of the global financial system and economic system, I would argue, since the Second World War. One thing that's very interesting is, the U.S. equity market has become, and had become even more so a year ago when we had the U.S. exceptionalism theme that was popular, the world's stock market, right? Money was flowing in from Canadians, from Europeans, from Asians, from everyone, right? Propping up the U.S. stock market. You might argue that it was those portfolio flows into U.S. stocks that helped inflate the U.S. stock market. So if you don't want that anymore, if you don't want to have a current account deficit, then you're not going to have the portfolio inflows, so you're not going to have a stock market that's as buoyant, right? And so, they're all linked. That's the challenge with the system. And that's why everybody has to do, how do we go from point A to point B when the whole system is integrated, both the capital market system and the underlying economic system? And it's a very difficult transition to make. But I think in the United States case, the challenge is that we are an asset-based economy. So we have to sustain asset prices because people have built their retirement portfolios on that. People have built their spending habits on their assumptions about wealth and so forth. And so it's a delicate balance. But the challenge, I think, is that the U.S. market was the big recipient from German flows into equities, Japanese flows. Canadians are either strategy in Canada is often built around, do I want to buy U.S. stocks or do I want to buy Canadian stocks? Or, but it's always, what do I want to do with U.S. stocks? And those flows have been very important. At one point last year, the U.S. equity market accounted for about 2/3 of global equity market capitalization. Far bigger than its GDP, right?
Right.
So, my answer to, if you're thinking about it as a Canadian, is, of course, like in many other things, diversification is important because the U.S. is the stock market that's very expensive. The U.S. has been stock market's been the biggest beneficiary of capital flows. So you have to reconsider this in light of not just the Trump administration's national security strategy, but the changing mindset of Americans, I would argue, about what they want their interactions with the rest of the world to be. We love the benefits of capital inflows, but we don't like the cost of a current account deficit. But you can't have both.
Right.
You can't
Right.
fix,
Right. And I guess like just as you were saying that, I was sort of in trying to piece together something that you had mentioned much earlier around, the starting point being very high in valuations. It's almost, I kind of picture what you were describing with respect to the capital flows into the U.S. market as almost like a rising tide helps all boats type of thing that's been happening over the last bit. And, there's been, I guess, tack on effects to that with the rise of passive investing and, kind of the broad index and so on and so forth. Whereas maybe, with a change in capital flows, starting valuations and investors around the world having to be more discerning, there's probably going to be a larger shakeout of winners and losers in the U.S. market, just a bit more discernment. Does that make sense connected to what you're saying, or is there
I
another?
think so. I mean, as you know, so what gets distorted in capital markets and the equity market, I would say, and it's been the past couple of years, is we had first, just very simply, for a number of years, we had the U.S. market and economy were really the only one firing in the world, right? Europe wasn't doing much. Japan wasn't doing much. China's sort of fallen out of favor. So we had a U.S. only thing. And of course, what I would say is that the U.S., nothing against Canada, the U.S. is really the only true capitalist economy in the world, right? So if you're a capitalist and an investor, you have a tendency to want to put your money in a place where you think the objective is to make stock prices go, make the economy do well, make profits, be the U.S. is a very pro-corporate kind of society, right? So that made all sense. And then you had the American exceptionalism theme, and then we have the AI theme, right? And so the AI theme is this independent thing floating around there. And that is, nobody else can replicate it at this point. I mean, China maybe, but in a different guise, and it's not globalized to the same extent. So, that I think complicates how one views this, the capital account national security strategy flow stuff, financial system with the underlying themes. But what we would argue, and we've been arguing for some time, is that the market got overly concentrated in the U.S. equity market. U.S. stocks were overly concentrated in U.S. technology stocks. Though the prices of those assets were extremely elevated, the earnings expectations were extremely elevated. Yes, it was a great theme in many ways, although more uncertain than the market often seemed to suggest. I mean, I don't know how AI is going to evolve. All I know is that we've assumed the prices of the assets suggest very well, extremely well. So, that was really the point, is everything had crowded into this handful of trades, and it made sense to diversify. Unfortunately, for Canadians, there are better places to diversify, I would argue, from the US than Canada, partly because of proximity, but also just because, there are other factors involved. But it makes sense to diversify within the United States market and outside the United States market. And the national security strategy, linking it back, I think reinforces why it's worthwhile as an investor to do that, right?
Right. That makes a lot of sense, and that actually moves us nicely to the next theme, which is Canada. And you mentioned in a previous answer the use of the economic power to subject. So as a Canadian, having conversations with other Canadians, and this topic around Trump in the U.S. comes up, it can get pretty emotional among
Sure.
some people. But I've kind of taking a step back from that, which is to say that Canada is deeply economically integrated with, the country that is really driving this disruption, of course, the U.S. And so when you think about economies in that position, highly interconnected, trade dependent, how does this framework apply, and what specific dynamics do, I guess Canadian policymakers, but maybe just Canadians at all, need to understand?
Well, I mean, I think, Carney, characterized it well at his speech in Davos and so forth. And that is, obviously in hindsight, which doesn't help us much, Canada should have been diversifying long ago. And they should have been diversifying when times were fat rather than when times are getting leaner, right? Of course, that's human nature to not do that. But, the way I look at Canada, so it needs to be done. The auto sector is overly dependent on the United States and United States technology, auto technology, if we can use that word in the same sentence with autos these days, but nonetheless. It's just Canada needed to be more diversified. And, having lived in Canada for a long time, and I've got a soft spot in my heart for Canada, right? Because it's a nice place, right? But I think the thing is that, you have to diversify. I hope Canada will not fall back to what it's done in the past and say, okay, let's diversify by trying to exploit our natural resources, right? Because natural resources are kind of a gift that you get, and you can utilize it effectively, or you can become dependent on it. But you can become too dependent on it. And, I think history shows that a lot of societies that have been dependent on commodities have found that they become stagnant. And the thing is, and this, but, Canada's got a tremendous amount of human capital, right? Brain power that can be leveraged. And having we're just living off the US demand and our resource capacity and so forth. Neither of those things, in my mind, is what Canada needs to be emphasizing, right? It's got the intellectual firepower to be successful. It needs to diversify. It can, but the same thing is true, but it's no more true than it is for Germany or Japan or Korea or Singapore. Again, it's very difficult to transition from one regime, a trade regime, that driven by the U.S. economy, by U.S. demand, by the U.S. financial system for 80 years, and transition. What I thought Carney said effectively, and I hope that it resonates among Canadians and others, is that everybody's dependent on the U.S. for a number of things. So everybody has an incentive to work together to try to provide buffers against the vicissitudes of U.S. policy should they persist, right? It's prudent anyway, but now there's a reason for to focus on it. But it's going to be tough. I will say this, if you look at the Canadian equity market, overly simplistic, I know, but there's financials and resources, right? Well, resources move to the global, to a global rhythm and the price. And the Canadian financial system is independent of the U.S. financial system in part because of regulatory restraints, right? I mean, it's been hived off in many ways, right? Of course, Canadian equity investors, I think, tend to be: do I want to buy bank stocks or not? And if I do I want to buy, one of 6 or 8, and I just swap between them because, so the market structure is okay because it's less dependent on the U.S. except it's only got these 2 options. Well, really, I mean, there's a few other things, obviously smaller counts, but so that's okay. But the challenge is it's not a capital market that's really designed to foster new company creation, finance innovative companies, startups, things like that. It's not built around those things that the U.S. has provided in the past, and that would be helpful. The other thing I'll say, though, is that if you're a Canadian dollar investor, well, you are a Canadian dollar investor, but when you're looking at your portfolio converted back into Canadian dollars, the challenge is the national security strategy is a document that says we want a weaker U.S. dollar. That's written in invisible ink, right? But that's what it says, right? Because we want to revitalize U.S. manufacturing, all that kind of stuff. A weaker dollar would be helpful to doing it. The Canadian dollar, of course, is going to be linked to the U.S. dollar. If the U.S. dollar falls, the Canadian dollar is going to fall against the euro, going to fall against the yen, all of that kind of stuff. So that's important, and that's another benefit of investing in non-U.S. markets, where the Canadian dollar might do okay against the U.S. dollar, but it'll probably weaken against other currencies, and that's a way to get, to benefit from that. Would be our view.
Yeah, that's a really interesting way to kind of play that currency angle for sure, because it's certainly on the minds of many investors, especially people who are looking for income or in stable returns out of their portfolio, that this overlay of currency is kind of a heightened risk from that perspective. So no, it makes a lot of sense. And in your point around the capital markets in Canada, it's just, as you were saying that, I just keep thinking to myself, yes, it'd be, it's some of that is maybe cultural, like around level of comfort for risk taking and entrepreneurship and so on and so forth. So some of that actually probably starts amongst the people, really trying to build something that's not financials or materials from that perspective.
Yeah, I mean, you know this better than I do, and everybody knows this. A challenge, sometimes there's an interesting corollary to Australia, right? Because Australia is an interesting not just because it has, an English or British heritage, or it's got a lot of commodities, but it's got it's got Sydney and Brisbane on one side of the country, and then it's got Melbourne in the south. I mean, you've got a long space between different places. And I always think of Canada's got north-south relationships more than it has east-west relationships in many ways, and that complicates things. But that's the reality that Canada has to live with. And again, Carney's thing about, and something that Canadians have been looking for a long time, is making it easier to trade with one another across province is extremely important in an environment where you're less reliant. You can rely less on the United States, and that means you can rely less on the north-south relationships that Canadian cities have with American cities, right? So you need more horizontal relationships in order to generate those benefits that you mentioned just a minute ago.
Right. Yeah, absolutely. And then I guess really the backdrop and the theme, even with this, in particular with the national security strategy, but you'd highlighted that these are sort of the winds that were blowing at some point in the other, and now there's basically a flag planted in the ground to say this is what we're doing. It's kind of what that strategy is saying, but it does sort of feel like the rules themselves are changing, and we spoke about diversification and so on and so forth. But how else would you recommend that people think about these rules changing and themselves and their business and their portfolios being in the midst of that, and maybe not necessarily what to do, but of course, please offer that if something comes to mind. But how to think, very clearly about it as there's noise and disruption and stuff that comes out in the news and in commentary and such.
Okay. Well, I'll start with the thing we talked about at the very beginning. It is important to recognize that the past is not prologue, right? Just because something went up a lot over the past 40 or 50 or 80 years or whatever doesn't tell you whether it's going to go up in the future. As a financial advisor would say, past returns are no guarantee of the future. And when you've had an unusual past, as we haven't had in capital markets in recent years, being more sober about what we can deliver, what an investor what you can deliver for your clients and what clients can expect, being more sober about that is important. And then being more diversified without just thinking, well, I can ride a tailwind and that'll solve all my problems or whatever. So that's important. But as we said at the very beginning, the challenge here is we're not confronting just a change in the, maybe in the capital markets outlook. We're really talking about a change in the fundamental structure of the global economy, capital markets, and financial markets that have developed over the past 80 years, right? Everything we've lived with as investors, whether you are 20, 50, or 80, everything we've lived with is in the process of changing because that system is no longer, before Mr. Trump came around, it was no longer fit for purpose, right? So everything is subject to a change, and getting your mind, or I think getting your mind around the notion that it's going to be different from here. It may be, sometimes it'll look noisy, sometimes it'll look more calm, but the underlying structure is going to be changing. And that's going to be maybe more important for somebody who's 25 years old than 75, but nonetheless is happening. And I think, the way I characterize it, and you had a prompt earlier, and I think it's true, is that this is this is the first chapter of a different book than we've been reading the last 80 years, right? Right. And so you don't notice it so quickly. We don't, using a book analogy, we don't know what the plot is yet, right? So when you don't know what the plot is, you've got to go along and sort of see how things are changing. But we need to recognize that it's a different book than the one we've been reading from over the past 80 years. How quickly or rapidly it evolves is harder to say, but it's going to be different in many ways, and particularly for Canada, given that you're sitting with 3,500 miles of border with the United States, and the United States is the one telling you, we want to change the system, right? And, now the caveat is, we could have a different administration in 2.5 years, but that system was going to change regardless. It's how we change, and whether it's a diplomatic or aggressive or whatever, but the system was going to change anyway.
Yeah, absolutely. That's such a great point, and it's something that I've been sort of lightly saying to people, and I was even having a conversation with a friend the other day. Really, it was kind of in that same ilk, but it was about institutions, and just institutions are going to change. Like, in this change, institutions are going to change. Some things that were useful in the post-World War II period, maybe less useful, and it might be hard for us to wrap our head around it. I'm not trying to predict this, but it's hard to wrap your head around no more UN, or something with some other kind of institution that we've held very dear and has been part of our lives, that might continue, but might not. And it's sort of kind of everything seems to be on the table.
Yes, everything is on the table. And if you think of it that way, constructing a global platform off of which economies and capital markets can function is going to be challenging. There's going to be missteps, big changes. any change is difficult, but big change is even more difficult. And it's my personal belief and our firm's belief that big change is coming, right? How slowly or how rapidly is harder to forecast, and what the ebbs and flows are going to be is difficult, but big change is coming.
Right, right. And I think that's a great point to end this on, Peter. I really thank you so much for your time and your insights and your commentary. I think a lot for all of us to really kind of digest and think about. I mean, some of those key themes around diversification and is very important. So I thank you again for your time and your insights.
All right, thank you very much. Have a good day.
Yes, you too.
And
You
good
take
luck.
care. Yes,
Bye.
thank you. Bye.
Bye-bye.